When Rob Fernandez analyzes potential investments for clients, he looks at what exactly it means for an investment to be green.
We won't just buy a green labeled bond for clients just because it says it's green.
More and more investors are interested in putting their money to work in a way that will help combat the climate crisis. And green bonds are the poster child of this kind of financing.
Environmental, social, and governance issues are here and matters.
And some big household names are getting into this space, like Apple, Pepsi, the New York MTA, plus a handful of massive banks. Not to mention governments around the world, like China, Russia, the EU, and more. This kind of bond issuance may top $650 billion in 2021. That's about 8 to 10% of all the bonds being issued around the world.
They're a growing part of the marketplace. They're going to continue to grow, and I think that's going to be a major part of the bond market.
So there's a whole new bond market within the bond market. Bonds as we know them work like this. An issuer, most often a company or a government, raises money by offering bonds to investors. They're basically IOUs. In exchange for getting money up front when you sell the bond, you pay the bondholder back over a certain amount of time with interest. Issuers use these bonds to raise money to invest in their business, employees, infrastructure, anything you name it. But green bonds are different.
The fundamental difference is that it's about what it's financing, first and foremost.
Money raised from these are earmarked for projects that are positive for the environment.
The one key difference is that the issuer makes a non-binding voluntary commitment to earmark the proceeds and use them for specific environmentally friendly projects. So it could be renewable energy, energy efficient buildings, clean transportation, clean water. But from a structure standpoint, they tend to be the same as the traditional bonds that issuer would bring to market, minus the green commitment.
The market here is bigger than just green bonds.
So we saw last year about $490 billion of green, social, and sustainability bonds combined. This year we're expecting about $650 billion across those three categories.
And that's up 32% from 2020.
So it just keeps going.
Sustainable bonds break out into three categories: green, social, and sustainability.
Social bonds would be used primarily for social purposes. Could be affordable housing or microfinance.
And the sustainability bond category here basically means a bond meets both green and social standards of issuance. The biggest slice of the pie goes to green bonds, with an expected $375 billion of issuance in 2021.
In 2020, green bonds reached about $1 trillion USD at the end of 2019.
And issuance is growing.
So it's a huge diverse mix. Banks, corporates, and governments. Anyone issuing or the ability to issue a bond is issuing when they have the eligible assets to do so.
Most issuances so far have been considered investment grade. That means independent rating agencies say those issuers are most likely to repay their debts. The other side of the bond market is more risky, often called high-yield bonds or even junk bonds. As for the buyers
are the big pensions. They're the big asset managers. They are the guys that really are putting pressure around the need for more green investments. Retail investors are having a chance to invest in muni green bonds, and that's not a common practice that's happening globally.
And I think that's going to be a major part of the bond market where the retail investor can get some participation in that.
When it comes to accountability,
to date, it's been largely, sort of a best practice document-driven market. But at this point, it's been a regulatory light market for the most part. The Green Bond Principles, which are sort of a best practice document that was put out by the International Capital Market Association.
For a green labeled bond, if the issuer is complying with the principles, the green bond principles, then there's certain parameters, certain guidelines they have to follow.
There's 4 core requirements that these bonds must meet, but it's a non-binding voluntary commitment. First is use of proceeds. It's basically the legal document that details how the money raised will be used for green projects. And to determine what's green, there's what's called a taxonomy.
The taxonomy's main objective is to help set the course on what is green. Think of it as a dictionary or catalog of what we mean by green.
The other core components include process for project evaluation and selection, management of proceeds, and reporting. They're all interconnected, and essentially it advises issuers to keep up-to-date information on how the money is being used and the project's environmental impact.
How are you going to manage the proceeds during the time of the bond? Are you going to use a tracking system? Are you going to ring fence the proceeds? And of course, how will you report on those? Is really the fundamentals on what the Green Bond Principles is trying to lay out.
All of this can be subject to second-party opinions, external reviews, and even verifications and certifications.
It's not one of the four key principles, but it's essentially a fifth, and many issuers are doing it.
And then they'll oftentimes will bring an external reviewer in to provide an opinion on the credentials of the offering and whether it aligns with either the Green Bond Principles.
And that's what investors actually rely on. They rely on that verification, that second-party opinion or certification of the green bond.
Think of those stamps you may see on coffee or paper towels, even ice cream, that are meant to signify to buyers that whatever they're buying is ethical or sustainable.
When we pick up a product in the supermarket and we make a decision on whether we buy the same product but of the different brands, if one has been, stamped by WWF or Rainforest Alliance, we have a tendency to go, I trust that label. It is a marketing component that comes with an assurance behind it that you can buy this product and know that the due diligence has been done.
But issuers don't have to do this.
Well, investors in the U.S. market are going to buy muni bonds, whether they're green or whether they're purple or whether they're pink. There is no guarantee what is being put out actually is green.
Some muni bonds are getting that external review.
And so, for example, like the New York MTA, they've issued green bonds and they've received a second-party opinion.
They definitely wanted that extra credibility, that it was somebody else, a credible, authoritative voice saying that this was green, not the MTA.
If the issuer decides to use all the money raised for something else, there's no regulation in place to punish them.
Typically, we haven't seen sort of legal repercussions in bond documents that say if the funds aren't used for specific purposes that it would be an event of default. So it's really been, what's sort of the reputational impact there could be.
That's why the rules of the game become so important in making sure we have the right standard frameworks and verifications happening.
Yeah, what's next for the sustainable green bond market? I do think we're going to see continued issuance.
Plus, the market is evolving to include sustainability-linked loans or bonds.
Interest rate is typically tied to the achievement of some sort of sustainability target. The coupon could step up by 25 basis points, for example, if a target's not hit at some point into the life of the bond.
It's almost as they're setting themselves up that they could have a financial penalty should they not achieve their goals.
There's only been about 15 to 20 billion of sustainability-linked bonds to date, but the vast majority of that has been in the last 6 months or so. So a lot of growth potential there, just still very early stages to kind of size the market.
And we'll also see a rise in different labeled products.
Like blue bonds or gender bonds.
Blue bonds have been issued as a way to look at either marine projects or ocean or water projects. We've seen some gender bonds, specifically looking at diversifying gender on boards or in the workplace.
There was a big U.S. bank last year that came to market with a social bond they called a racial equity bond. You could see the green label being used by issuers to support the infrastructure spending from the Biden administration plan.
And therefore, green bonds serves as a extremely useful tool in moving large amounts of capital towards those projects and encourages, obviously, this need to think about building out the infrastructure that is going to prepare the United States for the impacts of climate.
The only thing that's constant is change. And so when you see this new wave of green bonds and these topics arise on the environmental social governance side, it's great. It's great to see that the growth is there and people are actually paying attention to these details.